All right, no fluff. Let's get straight into it. We're seeing charts all over Twitter and socials. And
Yeah.
I mean, 90% of the trend lines people are drawing are absolute garbage.
Hold on, mate. Are we really dedicating a whole episode to drawing lines on a screen? I thought this was the Big Short Club, not, primary school art class. It's just connecting the dots in it.
See, this is why the CFA charter hasn't taught you how to actually read a chart. You think it's just dots. Everyone thinks 2 points make a trend line.
Hmm.
That's not a trend line. That's just a line. It means nothing. The market hasn't validated it. You need a third touch. The third knock on the door is the one you answer.
Okay, the three-touch rule. I've heard you CMT boys chanting that.
Right.
But which bit are you, touching? The candle body, the wick? I see people just dragging the line around to fit whatever crypto they're shilling that week. It's pure confirmation bias.
You're not wrong about the bias, but you're asking the wrong question. It's not about wicks or bodies. It's about confluence. You draw the line that price respects the most. So if you get 3 clean touches on the wicks and the fourth one just smashes through the body,
Okay.
your line is probably invalid. You have to be honest with it. The chart is talking to you.
Hmm.
You just have to listen instead of telling it what to do.
Okay, so it's more of an art than a science. Find the best fit. But what about the scale? I've seen charts where the same trend line looks completely different depending on the settings. You can make any story fit.
Now you're asking the right questions, Morgan. That's where the pros separate from the plebs. Log scale, mate. Always log scale for crypto or anything that's gone parabolic.
Right.
An arithmetic scale shows a 10-pound move as the same, whether the price is 20 pounds or 200. But a log scale shows you the percentage change. A move from 10 to 20 is 100% gain, from 200 to 210 is only 5%.
Yeah.
Log scale shows you the real momentum and stops you from getting faked out by what looks like a breakout on an arithmetic chart. It's about rate of change, not absolute numbers.
Right, that's just good data visualization. As a quant, I approve. So let's say I've got my 3 touches, I'm on a log scale, the line looks clean. Why should I, a fundamentals first CFA, even care? Tell me why this isn't just financial astrology.
Because it's your #1 risk management tool, plain and simple. You buy an altcoin, it's in a beautiful uptrend,
Okay.
bouncing off that lovely valid trend line. Where do you put your stop loss? Just below the line. If it breaks and closes below, the character of the trend has changed.
Right.
The game is different. You're out. It removes the I hope it comes back emotion.
A data-driven exit strategy. I can get on board with that. It's a clear invalidation point for the trade thesis. It's not about predicting, it's about reacting to a predefined condition.
Exactly. Now let's talk about getting in. Those touches, they are your entry points. Buying the third touch of a confirmed uptrend is one of the highest probability trades in the book. You're buying at a point of dynamic support with the trend in your favor, and you have a clear, tight point of invalidation. It's clean, it's efficient.
Okay, but not all trends are created equal, right? I've seen some of these meme coins with charts that go almost vertical. You can't tell me a trend line there is stable.
You're way ahead of me. That brings us to the slope, or the angle of the trend line. Think of it like climbing a mountain. A nice 30 to 45 degree angle.
Yeah.
That's a sustainable trek. You can keep going for a while. A 70-degree angle, that's not a trek. That's a free solo climb up a cliff face.
Wow.
It's unsustainable. The price is going to run out of oxygen and come tumbling down. Any trend line that steep is fragile. A break doesn't mean much because it was bound to break anyway.
So the angle of the trend line is a proxy for the momentum's sustainability. A steep line suggests retail FOMO is driving the price,
Yes.
not a steady institutional accumulation. The quality of the trend is low.
Spot on. And you need to look at the spacing of the touches.
Okay.
You need to, if you get 3 touches in 3 days, that's a lot less meaningful than 3 touches spread out over 3 months. Time validates a trend. The longer a trend line holds and the more it's tested over different market conditions, the more significant it becomes.
That makes sense. It's been tested over more macro news, more market cycles, more psychological regimes. So what happens when one of these significant, well-spaced, nicely sloped trend lines finally breaks? Is it just game over, trend reverse, sell everything?
Not always. And this, my friend, is where the real alpha is. It's the role reversal. A broken resistance becomes the new support. Picture a downtrend line on Bitcoin price keeps hitting its head on it for months. Then bam, it smashes through. The rookies and the FOMO crowd chase it. They buy in 10% higher.
Right.
The smart money doesn't chase. They wait. They wait for the price to come back down and kiss that old trend line from above. That kiss, that retest, is your confirmation. It's the market saying, yep, what used to be the ceiling is now our new floor. That is a prime, low-risk entry for the new uptrend.
The support-resistance flip, it's a classic principle in horizontal analysis, but applying it to a diagonal line is interesting. It implies a dynamic floor that's actively rising over time, providing a clear trajectory for entries.
Precisely. Now, here's a tricky one. What if the chart is a complete mess? All volatility, wicks everywhere like some low-cap coin on a mad one after an Elon tweet.
You stay away, like a sensible person with a fiduciary duty to their capital.
Or you use an internal trend line. This is where the purists and academics get their knickers in the twist. You deliberately draw the line through some of the wicks. You ignore the extreme panic sell spike or the one wild liquidation cascade, and you connect the clusters of price action, the candle bodies, where the real volume was traded.
Okay.
It's not cheating, it's filtering. You're a data guy. Think of it as removing outliers. You're making an educated hypothesis that this one wick was an anomaly, a fat finger, a liquidation cascade.
Okay.
Your true underlying trend is here. It takes discretion, and you can absolutely get it wrong. But in choppy, volatile markets, it can help you see the forest for the trees. The key is to be brutally honest with yourself.
Right.
Ask the question, are you filtering noise, or are you just drawing what you want to see to justify a bad trade?
That is the million-dollar question, isn't it? The fine line between sophisticated data filtering and simple confirmation bias. I suppose the only way to know is to test it. Formulate a strict set of rules for drawing them and backtest it over thousands of examples to see if it has a positive expectancy.
And that's why you're a CFA. Laughing always back to the spreadsheet. But in the live market, it's about judgment. One last concept, the trendline takeoff. You see a perfect valid trend line, prices respecting it beautifully, and then suddenly the price goes absolutely parabolic.
Right.
Like launching itself miles away from the trend line. The rookies see that and they finally get the confidence to buy. They FOMO in right at the top.
While the early bulls who rode the actual trend are happily distributing their bags to them. A climax run, the terminal phase of a bull market.
Exactly. That explosive move away from the trend line isn't a signal of newfound strength. It's often the final exhaustive gasp of the trend before it collapses under its own weight. It's a massive warning sign, not an invitation to the party.
So a valid trend line is more than just connecting dots.
Yes.
So it's a multi-factor model. You need at least 3 touches. You should use a log scale. The slope has to be sustainable, and the touches should be well spaced. Then you have advanced concepts like role reversals for high probability entries and filtering with internal lines in messy conditions. It's a framework for assessing probability and managing risk.
Triumphant. He gets it. There's hope for you yet, mate. You might make a decent trader one day once you get your face away from the discounted cash flow models. And for everyone listening, don't just take our word for it. Get in on the discussion. Join the chat group. The link's down below. We want to see your chart crimes and your masterpieces.
All right, so it's not just primary school art class. There's a system, a logic. It's a visual representation of the collective psychology of the market as it's being written second by second on the chart.
Now you're talking. It's the story of greed and fear of supply and demand right there in a single line.
Okay, I'm less skeptical, but I will be backtesting everything you just said with rigorous statistical analysis.
I would expect nothing less from you. All right, that's a wrap for us.
Now, here's a question we'd like you to think about. If a perfectly valid, long-term trend line that has been respected for over a year finally breaks, but the key fundamental data for that asset has just turned massively bullish, which signal do you trust more, the chart or the story? Let us know in the chat.